Are you looking at a stock that is like a screaming strong buy and heavily undervalued?
Or are you staring straight into a massive value trap?
Yeah, exactly. Because that is the ultimate question we're dealing with today.
It really is. I mean, the surface numbers for this one look almost, well, too good to be true.
Right.
But then you look at the underlying charts, and they're flashing these really subtle, kind of mixed signals.
Which is wild. So we are tackling that exact dilemma right now. Welcome to the deep dive. Today, our mission is focused entirely on Micron technology, ticker symbol MU.
And we have a literal mountain of data to get through.
Oh, absolutely. Financial data, technical signals, Wall Street analyst ratings. We are going to sort through all of it to figure out what is actually happening under the hood of this AI infrastructure, darling.
But before we jump into those numbers, we do need to get the housekeeping out of the way.
Yes, please do.
Just a quick reminder that everything we discuss in this deep dive is strictly for educational and entertainment purposes only. We are analyzing data and market mechanics, but absolutely no financial advice is being given here today.
Definitely. And while we're on the subject of housekeeping, please do us a huge favor and like the video, subscribe to the YouTube channel, and most importantly, leave your feedback in the comments.
Yeah, it's compulsory at this point.
It really is. It helps guide what we cover in future deep dives, so we really need to hear from you.
All right, so let's set the stage here.
Let's do it. So as we sit here today, Micron is trading at $449.38 a share.
Okay.
It's up a very modest 0.21% on the day. But, analyzing a single day's price action is a bit like, I don't know, looking at a single pixel on a 4K TV.
Yeah, you don't see the broader picture at all.
Right. You have no context.
You really have to zoom out. Because despite some of the short-term volatility we've seen lately, Micron is riding this remarkably strong long-term uptrend.
And the engine pulling that whole train is their role in the AI infrastructure boom, right?
Precisely. Specifically, we're talking about high bandwidth memory, or HBM.
Okay, HBM.
Yeah, their HBM3E and HBM4 chips are just the absolute lifeblood of modern AI servers.
Let's actually pause right there for a second,
Sure.
because we hear the term HBM thrown around constantly in financial news. But to really grasp the financials we're about to look at, we need to understand the physical mechanism.
That's a good point.
Why is high bandwidth memory so critical that it fundamentally alters an entire company's valuation?
Well, look at it this way. Think of a modern AI processor, right? Like the massive GPUs driving machine learning.
Okay, yeah.
Think of it as a high-performance V12 engine. To get maximum horsepower, that engine needs fuel fed into it constantly and, well, rapidly.
Right, it can't just trickle in.
Exactly. Traditional memory chips are like trying to feed that V12 engine gasoline through a tiny plastic coffee straw.
Oh, wow.
The engine literally starves.
Yeah.
It physically cannot process the AI models because the data just can't reach the processor fast enough.
So it creates a severe physical bottleneck in the data center.
Yes. And what Micron's high bandwidth memory does is replace that little coffee straw with a high-pressure fire hose.
A fire hose, I like that.
The data flows almost instantaneously. And that allows the AI processors to actually run at their maximum capacity.
And since training these massive AI models is basically the absolute top priority for every major tech company on the planet right now.
Whoever controls that fire hose effectively controls the timeline of the entire AI revolution.
Which perfectly explains the immense leverage they currently have.
It really does.
Because, when you look at their fiscal Q2 2026 earnings, which is the quarter ending February 26, 2026, you see that leverage manifesting directly in the numbers.
Oh, the numbers are staggering.
They really are. I have them right here. Quarterly total revenue came in at $23.86 billion.
Which is up an insane 196% year over year.
Almost tripling the revenue. It puts them at an annualized run rate of $58.12 billion. And GAAP net income sits at $13.79 billion for the quarter alone.
That's just a massive amount of cash.
With diluted earnings per share at $12.07. Annualized, that is over $21 a share.
It's an unprecedented leap in profitability for a manufacturing business. I mean, it really is.
Okay, let's unpack this, because Micron is basically selling the shovels for the AI gold rush. But these shovels seem to be made of solid gold themselves.
Right.
Let's look at the gross margin. It jumped from 37.9% last year to a jaw-dropping 74.9%.
Nearly double.
Yeah. And I have to push back on the reality of this for a second. We are talking about a physical hardware company.
Correct.
This is a business that literally mixes chemicals, builds multi-billion-dollar clean room factories, and prints silicon. Reaching software-level margins that fast is practically unheard of.
It is.
So if they control the bottleneck, as you said, can't they just throttle supply to keep those 75% margins permanent?
Well, what's fascinating here is the pricing power Micron suddenly has. But throttling supply forever, that's the multi-billion-dollar question the market is trying to figure out.
Right, because they aren't the only ones making memory.
Exactly. In the short term, yes, they have absolute pricing power. There is vastly more demand for these specific HBM chips than there is supply.
So they can just name their price.
Pretty much. When you're one of the few who can sell the fire hose, the massive data centers just had to pay whatever you asked.
But long term.
Physically throttling supply forever isn't realistic, because they have competitors who are also racing to build their own factories.
Right.
But right now, today, that pricing power is flowing straight down to their balance sheet.
And it's creating a massive financial safety net. I mean, they generated $11.90 billion in operating cash flow just this quarter.
Yeah.
And a very strong $6.9 billion in adjusted free cash flow.
Which gives them a fortress of a balance sheet. They are sitting on $16.7 billion in cash and marketable investments.
Wow. Compared to what in debt?
Only $10.8 billion in total debt.
Oh, so they have negative net debt.
Exactly. Having negative net debt in an industry that requires this much capital expenditure is a massive strategic advantage.
It lets them weather future storms.
Yeah, and they clearly want investors to know they feel secure in this cash flow. I mean, they just increased their dividend by 30% to 15 cents per share.
But wait, if a hardware company is suddenly printing money like a software monopoly, Wall Street usually prices that in aggressively, right? They push the stock up relentlessly.
Usually, yes.
Yet, looking at the current charts, there is some weird friction happening. The momentum isn't matching the flawless financials.
That's because the market is a forward-looking mechanism. It's always trying to price in what happens 6 to 12 months from now.
Not what happened last quarter.
Right.
Well, let's look at the price tag and the technical analysis to see what the market is anticipating. The 52-week journey for this stock is massive.
Huge.
It went from a low of $65.65 all the way to a high of $471.34.
Which pushed their market cap to roughly $506.78 billion.
Over $500 billion.
Yeah.
But the current daily action is telling a more subtle story. The daily volume is holding steady, averaging about 39.79 million shares over the last 10 days.
Okay.
And structurally, the trend is still up. We are above the 50-day moving average, which sits at $408.83.
Right.
And we are way above the 200-day moving average of $261.50.
Which confirms the broader macro bull trend is still very much intact.
Yeah.
The long-term holders, they aren't abandoning ship.
True, but the internal momentum metrics are where I'm seeing that friction I mentioned.
Let's hear it.
The RSI, the Relative Strength Index, is sitting at 62.63.
Okay, so neutral to bullish.
Exactly, neutral to bullish, but importantly, it is not overbought. Retail traders haven't pushed this into a complete speculative frenzy yet.
Right.
But then you look at the trend strength indicator, the ADX, and it's dropping down to 20.60. Yeah. For anyone tracking institutional movement, an ADX that low tells us the conviction behind this upward move is fading.
It is.
So my question is, if we aren't overbought, why is the big money taking its foot off the gas after this parabolic run? Are we running out of gas?
That is the exact psychological narrative the numbers are giving us right now. What you're seeing in those momentum oscillators is the market essentially digesting its own massive run.
Just taking a breather.
Yeah. The MPD indicator is sitting around 14.65. That's still technically bullish.
Okay.
But if you look at the daily views, it's showing a slight bearish divergence.
Meaning the price is managing to hold steady near the top, but the underlying buying pressure required to push it higher is actually thinning out.
Precisely. The heavy institutional buyers who aggressively rode this stock from 65 to 450.
They aren't adding to their positions.
Right. Not at these levels anyway.
Sure.
Not with the same ferocity. They're waiting. It's not necessarily a crash signal. It's more of a reevaluation phase.
A cooling off period.
Exactly. This is why that 50-day moving average of $408.83 is so critical,
Okay.
along with the Bollinger Middle Band. at $397.15. As long as the price holds above those levels, the buyers are still technically in control.
But breaking through the resistance at the 52-week high of 471.34.
That is going to require a completely new wave of massive conviction.
So the market is essentially trying to figure out if the AI narrative has enough juice for another leg up. And this pause in momentum is exactly what forces the ultimate debate of this deep dive. When you see a high-flying stock stall out after a historic run, are we looking at a dip to buy?
Or are we standing on the edge of a cliff?
The classic undervalued gem versus the massive value trap.
Yeah, that's the debate.
So let's start with the bull case, because Wall Street analysts are overwhelmingly in love with this stock right now.
Oh, they love it.
89% of analysts have a BUY rating on it, 7% say hold E, and only a tiny 4% have a sell rating.
That's a huge consensus.
It is. The average price target is $464.61. But you have firms like Cantor Fitzgerald throwing out a massive $700 high target.
A $700 target implies they believe the fundamental business model of Micron has permanently shifted.
To a higher tier of profitability.
Exactly. They don't see this as a temporary spike. They see it as the new normal.
And they justify that target with the valuation metrics. Proponents of the bull case point out that Micron is currently trading at a 12.5 forward PE ratio.
Right.
And they validate that seemingly low multiple by pointing to a massive 600+% EPS growth forecast for 2026.
Wow.
Yeah. I mean, on the surface, if a company is growing earnings by 600% and you can buy it for 12.5 times next year's earnings.
That feels like the bargain of the decade.
It really does. It looks incredibly cheap on paper. A 12.5 multiple in the tech sector is usually reserved for, like, legacy hardware companies with zero growth.
Not companies at the absolute center of the AI boom.
Exactly. But here's where it gets really interesting. The bear case, the argument that this is a trap, relies on discounted cash flow or DCF models.
Okay, the DCF models.
And those models suggest the stock could actually be overvalued by up to 70%.
70%.
Yeah. So we have one set of numbers screaming that it's a strong buy and another set of highly sophisticated models saying it's 70% overvalued.
It's a huge disconnect.
How do we reconcile that?
Well, if we connect this to the bigger picture, this is the great paradox of semiconductor investing. And it's perhaps the most important insight to grasp about this entire sector.
Okay, lay it on me.
When the PE ratio looks the absolute cheapest, that is exactly when the stock is historically the most dangerous.
Wait, really? Why is a cheap valuation suddenly dangerous?
Because of the brutally cyclical nature of memory chips. That 12.5 forward PE assumes the AI party never stops.
Right.
It assumes those $23 billion quarterly revenues and those 75% gross margins are the new permanent baseline for the company.
But the DCF models work differently.
Exactly. They project cash flows 5 to 10 years out and discount them back to today.
Okay.
And those models are pricing in the reality that memory chips are historically a boom and bust business.
Ah, so when there is a severe shortage like we have right now with the HBM fire
It's a
hoses,
skyrocket.
margins expand and earnings explode.
Yes. But those exploded earnings artificially deflate the PE ratio. The E in the price-to-earnings ratio becomes massive, right?
Oh, I see. Which makes the overall multiple shrink.
Exactly. It makes the stock look quote-unquote cheap. But eventually, supply always catches up.
Companies build new factories.
Chips flood the market, prices crash, and those massive earnings vanish almost overnight.
So the PE ratio is basically lying to you because it's using peak earnings as the baseline.
Yes. And this is exactly why retail traders often get utterly trapped.
Wow.
They look at a chart at all-time highs, they see a forward PE of 12.5, and they think they're buying a value tech stock.
But they're actually buying right at the absolute peak of a cyclical earnings cycle.
Bingo. If earnings drop by half next year because supply caught up to demand, that cheap 12.5 PE ratio doubles to 25 overnight.
The perceived value just evaporates.
Yep. The fundamentals deteriorate and the stock price plummets to adjust to the new reality.
That makes total sense. And it completely changes the context of how you read these valuations.
It really does.
To figure out if we are actually at the peak of that cycle right now, we need to look at the downside risks and what the insiders are actually doing with their own money.
Oh, following executive movement is always a revealing metric. They have a way better view of the internal cycle than anyone else.
Well, we do have a very specific data point here.
Let's hear it.
Executive Vice President Sumit Sadana, recently sold 24,000 shares of Micron,
Okay.
cashing out around $10.1 million.
Interesting.
Now, if Cantor Fitzgerald is right and the stock is heading to $700, why is the executive VP taking $10 million off the table right now?
Well, we do have to maintain some perspective here.
Okay, sure.
Executive compensation is heavily tied to stock options. Selling shares for tax purposes or simply taking some profit when your company hits record highs is a standard corporate move.
Fair enough.
Executives often use scheduled 10b5-1 trading plans to sell shares automatically. It doesn't necessarily mean the boardroom is secretly panicking.
But it does mean he is perfectly happy locking in his gains at $450 rather than risking it all waiting for $700.
That's true.
It signals that we need to pay close attention to the real-world risks that could derail that bull case.
Without a doubt. When insiders take chips off the table, we should at least look at the threats they are managing.
Right. So what are the biggest threats?
Well, the most immediate risk to their free cash flow is their own capital expenditures.
The CapEx.
Yeah. Micron isn't just hoarding that cash we talked about. They have massive spending plan for 2026. We are talking over $25 billion in CapEx to build new facilities and expand production.
$25 billion. That is a colossal drain on future cash flow.
It is.
Which ties directly back to what we were just talking about, right? The cyclical trap.
Exactly.
That $25 billion is being spent to build the very factories that will eventually flood the market with chips and potentially crash their own 75% margins.
You nailed it. They are racing to meet the current insane demand, but the risk is always overbuilding, just as demand normalizes.
And what about the geopolitical side?
Oh, that's huge.
Because if they are spending $25 billion to make more chips, they need a global market to sell them to.
That is the second massive risk here. The semiconductor industry is the premier geopolitical battleground right now.
Without a doubt.
High bandwidth memory isn't just a commodity anymore. It's a national security asset in the global AI race.
Right, because of the U.S. export controls to China.
Exactly. We're seeing increasing restrictions. If the U.S. restricts where these high-end chips can be sold, a significant chunk of Micron's target market vanishes overnight.
Just poof, gone.
Yeah. You do not want to be holding the bag on $25 billion in new factories if half your global customer base is suddenly legally off limits.
Especially given the broader market sentiment shift we're seeing right now.
What do you mean?
Well, the pure AI fervor that drove stocks up 200% on just the mention of machine learning, it's starting to mature.
Ah, yes.
The broader market is slowly rotating toward value stocks and demanding real, sustained earnings. The expectations for companies like Micron are just astronomically high right now.
They are. And because of those elevated expectations, any flaw in the narrative is going to be severely punished.
Right.
It's no longer enough just to have a good quarter.
Yeah.
If they beat earnings but issue guidance that is even slightly below what Wall Street secretly expects.
The market will aggressively reprice the stock.
Exactly.
It's the curse of high expectations.
Yeah.
You don't just have to win the game, you have to win by 50 points every single time, or the crowd turns on you.
That's a great way to put it.
So let's synthesize all of this.
Okay.
Give us the summary horizon. Where do we stand on the short term versus the long-term outlook for Micron?
All right, well, from a long-term perspective, Micron's trajectory remains entirely anchored to the continuation of the AI infrastructure build-out. If the major tech giants keep scaling up their AI capabilities and building new data centers at this aggressive pace, the demand for high-bandwidth memory will absolutely sustain the bull case.
But in the short term.
In the short term, however, the picture hinges on the technicals holding up. Amidst this cooling momentum environment we discussed, investors need to watch that $408.83 support level very closely.
Right, the 50-day moving average.
Exactly.
Yeah.
If it breaks, that institutional pause we talked about could turn into a much steeper, more painful correction.
For everyone tracking this at home, you know, the next major fundamental catalyst you need to watch is July 1st, 2026.
Mark your calendars.
That is when fiscal Q3 2026 earnings drop. Expected revenues are hovering around $33.5 billion.
Which is a massive number.
It is. And whether they hit that number, and more importantly, what they say about their future margins, will set the tone for the entire semiconductor sector for the rest of the year.
It is going to be a pivotal report for sure.
There's so much more we can unpack here. I mean, in future deep dives, we might explore the specific intricacies of the Nvidia Micron partnership,
Oh, that would be a good
or
one.
perhaps do a direct comparison of Micron's production yields against competitors like Samsung.
Yeah, but this raises an important question to leave you with, though.
What's that?
We just discussed Micron spending $25 billion to build more capacity, right?
Right.
But what happens to that record 75% gross margin if the major AI data centers finish their initial massive build-out exactly at the same moment that Micron's new factories start flooding the market with millions of new chips?
Man, that is the ultimate question. So what does this all mean for you? Are you buying the ultimate bottleneck of the AI revolution, or are you buying right at the peak of the cycle just before supply catches up?
We really want to hear your take on this.
We do. If you found this deep dive valuable, please subscribe to the show and leave your feedback in the comments. Your thoughts truly shape what we cover next. Stay curious, and we'll catch you on the next deep dive.